Awesome. Right. Hello. Welcome, everybody. We are finally here heading into VSGD careers. Hopefully, it decided that it might not like us to do that today, but it seems like we are finally on the right track. So welcome along to another Friday Finance. Happy Friday. Can't quite believe we're here already. Obviously, we've had a week out and we've regrouped and we signposted at the last session that we were going to be talking all about finances with children in mind for veterinary professionals. So you might have heard a few times when we've been on the VetU webinars, we've had Ruth as a guest. We've just nodded to, oh, this would be really useful if you've got kids to bear this in mind. Think about this for your children's future. And we realised we've got loads of parents within the veterinary profession that maybe have put things in place or maybe actually hadn't got any idea that there are things that we can start to look at. So Ruth, it seems like a massive topic. And again, we've nodded to this lots of times, little bits on like junior JISAs, what we can put in place for our kids. Can you give us a general overview of like the key areas that we can think about for financial planning as parents?
Wow. Yeah. Well, there's nothing more whenever I talk to parents that they want to go into is protecting their children or setting something up for them. So this is a great topic. So there are savings plans. So we'll talk a little bit about things like junior individual savings accounts that they can have. Some people on the call might have child trust funds that are in place or have heard that term. So what does that mean? We'll also have a look at something else, which is a bit of a Brucey bonus. Did you know you can save into a pension for a child? That's a bit left field, but it is an option as well as other things like such as insurance. Like what insurance as a parent could you look at putting in place? And wills, things like that, powers of attorney. So there's a few things to cover actually, I think, today.
Definitely. And that's aside from all of the like budgeting, planning, looking at how can we make sure that we can afford things, which I realize is a pressure for a lot of people. So we're going to look more down the route today of like those financial product pieces, working with a financial advisor, because I feel like this could be a session that was a few hours long if we were to look at like money mindset, budgeting, how we're teaching kids around money. That's a whole conversation in itself. But I just wanted to pick up on one of the things that you had talked about there, which was the junior JISA, or maybe it's called a JISA, I believe, as well. Like, can you tell us a bit more around what that is, Ruth, and how we set one of those up if someone's thinking about one for their children?
Of course. Well, there's lots of different ways that you can set up a junior JISA, also known as a JISA. You might have heard of it. I talk a lot about individual savings accounts. They can be cash as well as stocks and shares ones that we talk about for us. And you have a 20,000 limit a year. Well, for children, they've got one just as well, which is £9,000. And that is what a junior JISA is for. And that's how much £9,000 you can save every tax year. And it's locked away until the child reaches 18. So it's a form of like permanent tax-free saving or investment wrapper aimed to encourage families to save for the children's futures, basically. And it can be split. There's two different ways you can split it. A junior cash ISA, and that's where the cash simply, it's like in a tax-free savings account. The only risk with that is that, of course, inflation, it might be at risk for that. And then you've got stocks and shares, junior ISAs, and the returns, once again, depend on the performance of the stocks and shares that we're invested in. So they're a great little savings tool.
So interesting. And we are actually going to be covering savings and investments in more detail because Ruth is doing a webinar for us in September on the 20th. We'll get the link in the comments afterwards as well. So if you're like, oh my goodness, savings ISAs, stocks and shares ISAs, this is all going a bit over my head. We are going to be going into that in more detail so we can pick up more on that. And that £9,000, that doesn't eat into the parents' ISA allowance, does it?
No, that's a great question. It doesn't. It's separate. So adults have £20,000 in a tax year and children have £9,000 in a tax year. And you can set them up all different ways. I can set it up, financial advisors can set it up, or there are other ones available as well.
Amazing. And this is just probably a slightly off the cuff question. So at the moment, obviously, they've got £9,000 tax-free allowance, which we could put in. Is that right? So we can have tax relief on that.
Yep.
If we've got that set up, but we've got like grandparents wanting to put into it, and we've got family members wanting to put into it, and we've got birthday money and things like that going in there. Is there anything to consider around that, or does that all
100%.
get easily sorted?
That's one of the main reasons why people set them up, is as well. So for instead of getting gifts, people can actually save for them for when they're 18, for something like a car, or, you know, first property or something like that. So yeah, we have ways of where they can pay, not just the parents, but they can pay directly in to the junior ISA themselves. However, how often ever they want, whether it's monthly, whether it's lump sums, so many different options, but that's available.
Cool. And I think you touched on it again at the beginning too, but we've heard of like trust funds. Like, what's the difference? Trust fund, ISAs, are they the same? Are they different? Like, tell us more.
Brilliant. So a child trust fund, or CTFs, they were offered between 2002 and 2011. Any under 18s born before, I think it was the 2nd of January 2011, would have had a child trust fund automatically opened for them by the government. So kids got free cash vouchers of up to £250, or I think it was 500 if they were low income earners, from the state, and that would be added into the child trust fund. But they're no longer available to new account holders, as they were replaced by the junior ISAs in 2011. So if your child does have a trust fund, a child trust fund, you can convert it to a junior ISA. And that's like a major boost for them with, you know, then with a cash child trust fund, where rates tend to be like far worse than junior ISA rates. And many actual banks and building societies abandoned child trust funds, instead concentrating on better rates with the junior ISAs.
I did not realize that. So that's more something previously that maybe some people that have got kids that are like over 11ish might have in the background as well. And again, if anyone's listening to this and you're like, okay, there's quite a lot of terms that are being used here, I'm not sure what's going on, Ruth is always happy to speak to members of the VetU community, members of BSGD careers. You know, come to us at VetU, we can direct you, we can pop you in contact with Ruth, and she can help you figure out what you've already got and maybe help you plan towards what you might like to do as well. So again, just me with my VetU hat on, and hands off, I'm not a parent, very much so I'm probably coming into this asking all sorts of questions that many people might know already. But we talk at VetU a lot around protection policies, and we've been on here talking about income protection, critical illness cover. As people are having families, and as they've got more people that are dependent on them, and life is changing, what do we need to be thinking about in terms of protections as we've got kids around too? For us?
So, well, something quite great, it all depends on affordability, but there's something called family income benefit, and it's a type of life insurance policy, but it's different to like a standard life insurance, in that it pays out a regular monthly income rather than a lump sum. So you as a policy holder, you'll pay a monthly amount, and it will be covered for a specified amount of time. So it pays out if you die during the length of the policy, known as the term. So if you took out let's just put as example, if you took out a 20-year policy and you died after 5 years, your provider would pay an income for the remaining 15 years. Or if you died, on the other hand, at 18 years, then it would only pay out for the last 2 years. So it's different to a life insurance policy, which would pay out an agreed lump sum when the policyholder dies.
And in terms of things like, because obviously we've had a chat around critical illness cover already, and we'd said that could provide you with a lump sum if you had one of the illnesses on the list that was listed with the cover that you got as well. Presumably you'd said on that as well that sometimes there was a crossover between life insurance and critical illness might be an add-on. Do you get critical illness added on to that as well sometimes?
Not as far as I'm aware with family income benefit, no. It's a separate policy. I think it only tends to be covered as a bolt-on to life insurance, which, just so everyone knows, life insurance, it can offer a lump sum payment, which can clear off outstanding debts like a mortgage or something like that, or give your partner money to live off, to help pay bills and living expenses.
Amazing. And I think one of the things we always come back to in these conversations is like everyone's an individual, everyone's going to have different affordabilities, you're going to have different circumstances, there will be different outstanding debts, different incomes. If you're the main earner in the family, maybe that's going to be a different consideration to policies for, say, partners and so on, and histories and stuff. So again, it just comes down to, just like we do with our own patients, treating them as individuals, knowing the background, knowing the history, and coming to someone that does this stuff day in, day out. And I think as we touch on life insurance, and this was one when I was thinking about the questions that I wanted to ask you, that you're a bit like, we don't talk about this very often, but we probably should.
We're so British.
We are so British. I guess we probably do need to talk about like wills and plans for if things did happen to us. Do you want to talk around a little bit more around that in regard to our children and financial planning?
Oh yeah, wills are very important. It's a legal document, first of all, that you can create that sets out instructions for who will inherit what you've got, pretty much, also known as your estate, and what should happen if you die. So it's down to things like, what would you want your funeral to be like and where for it to be? And I know it's morbid to talk about, but it's also important because a will specify specifically who you would want your money to be paid to. Because if you don't have one, then you kind of, it gets paid. You then operate with what's called the rules of intestacy. So it will follow a certain pattern if you don't have a will. So if you have no children, then it would first, your estate would go to your living parents. But if your parents aren't alive, then it would go to your brothers and sisters. If they're not alive, grandparents, so on, so on, so on. So it follows a pattern if you don't have a will. So it's important to specify who would you want looking after your children, God forbid, if anything happened, things like that.
And that's all peace of mind, isn't it? As much as, like you say, it feels very uncomfortable, especially when we don't talk about these things. But actually, once it's done, yes, you do revisit these things at life changes, presumably, but it's done then, isn't it, as well?
100%.
Is there anything else that we've not quite touched on there? I think one thing, actually, because we haven't dived into this, and you mentioned it at the beginning, and just before we started talking, it really blew my mind. You can save into a child's pension. How does that work?
Yeah, you can. So look, it sounds like a bit absolutely crazy, but starting a pension for a child when they're so many decades away from retirement can seem like an odd thing to do, but it's such a great savings tool, because think about compound interest, and think about when you reach 18, like you have other things that you start to save for, like maybe, like I've said, a car, maybe your first property. So your pension isn't your priority, whereas parents can save up to 3,600 per tax year for them, and that over time up until they're 50 odd. Can you imagine, because of the compound interest constantly being added, what that could get them? It's a wonderful way to set children up if you don't want them necessarily to have access at 18. But there's so many different savings tools as well, so definitely reach out to somebody to just have a chat about options.
Yeah, that's amazing, isn't it? Because we touch a lot on our social media posts about compound interest, because it is mind-blowing when you sit and think about it, because some people may know what it is, some people won't. And just, this is my very crude overview, so please do jump in, Ruth. But essentially, if we've got an investment of, say, £1,000 that's sat there for a year, and we've got a 5% return on that, we've then got £1,050 at the end of that. But then the next year, you're going to get, if it's 5% again, like obviously this is just a figure I've pulled out, you're not only going to get 5% of that 1,000, but you're going to get 5% of your £50 from last year as well, which is then going to mean that we get like however much, £52.50 or whatever that is on top. And then the next year we've got £1,102.50 that we're going to get 5% on that whole thing. So if we're leaving that for kids for, I don't know, we're doing it when they're born, and it's going on, even if you get to 18 and stop paying into it, then you've still got 5% on top, on top, and top. It just blows my mind, compound interest, and how I wish someone had come along to me and told me probably 10 or 15 years ago, and I would have been firing more money into the places that would be gaining a return on my investment, I think. So
a lot of people don't ever consider it, but it's fantastic. It's a really great savings tool.
Absolutely. And just the fact that you leave it there, sometimes you can keep adding to things for compound interest, obviously, but even the fact that it's there and you get an interest on your interest. So Ruth, if anyone's been listening and they've heard you talk about junior ISAs, they're not sure whether their kids have got a child trust fund or not, where it is, they might know where it is, they might want to convert it to a junior ISA. They're maybe thinking about, what should I be doing about this estate planning, will wise? Do I need to change my life insurance now my situation's changed? Is critical illness cover right for me? Is it enough? They want that whole overall view and they want help with this. Like, what does that look like working with you?
It's a simple, fun, straightforward chat that you just have. There's no airs or graces. We just have an open conversation, and then I would chat to you about options, all the ones available, and we work out what's the best one for you and your circumstances. It's as simple as that. So even if it's just a bit of information gathering, because it can be a lot what we've gone through, and you're like, but we're going through so much to cover a lot. But not all of that might be relevant for someone. So yeah, I had a call today and it was a case of, no, this isn't what you need. That's probably more where you're going to be directed to, because, and then you explain the circumstances. So yeah, just reach out. You have you have a fantastic option where they can book in with you. So
we do, absolutely. We've got a Calendly link where you can see Ruth's diary, you can book in, you can drop us an email, hello@vetu.co.uk. Those first calls are complimentary. Ruth is 100% transparent. You're not going to get an unexpected bill. If you get to a point where you do need to invest into a product, or you're doing something with whatever we've spoken about, and there's going to be a cost involved with it, Ruth is going to tell you you're not going to get a bill that just arrives. So honestly, we've got an amazing financial professional that's sat here keen to help the profession. And this is a really key topic, because actually when we've got the education, the information around this, and knowing that if we do have the funds to put something aside for children, the next generation, and you want to do it, and it feels a bit like, oh my God, am I doing the right thing? Ruth's here. Like, she's happy to look at your situation, give you options on the table. That's everything that's about. She's not going to tell you what to do.
Do you know, one thing we didn't mention is it's not just if you've got kids. Do you plan to have kids in your life? Because you can put a little pot together ready for when that time comes to make it a bit easier for you. So it can also be about planning to have children. I've had someone save up for an IVF fund and they've not even started trying yet. So there's lots of different ways that you can save and put something in place for it.
Absolutely. And I think that comes back to what we were saying just at the beginning as well, doesn't it? That when you start looking at financial planning with children in mind, it is a wide topic. Like, do we want to dive down the fact that actually most of our beliefs around money come from what we see our parents do and what we've been taught at school and what we've seen in the media and the press and things like that? That's a whole topic in ourselves on like role modeling and education for children. We've got, like you say, the financial planning of before having kids. Like, how are we going to set things up here? We've got the budgeting piece. And then luckily today we've had this 15 minutes to be able to go through the financial products. What can we put in place for them? And again, that's the value of speaking to someone like Ruth, is you can go through, work out what the affordability is, work out what you've got available, what you've got free there, how many kids have you got, what you're planning on doing future-wise, and then thinking, oh, okay, you know what, maybe a pension's best place, maybe a junior ISA's best place. Maybe actually you sit down with Ruth and sometimes she'll say, you know what, it might be useful working on an emergency fund first, because actually we've not got one of those in place if the boiler suddenly goes. And she is just your best financial friend. So please do take advantage of Ruth's kind offer if you want to chat more through these things. If you've got questions that have come up off the back of this, because we've covered a lot of topics in a very short period of time, drop them in the comments under this and we're more than happy to come back. I can loop Ruth in for you. I can ask the questions. We'll be doing another Friday Finance next week as well. So if you've got suggestions on what you'd like to see covered, please do. 2 weeks ago, we did what I need to know around finances as I change my job. We've done pensions, we've done income protection, we've done investments, we've done critical illness cover. You can go and catch up on all of those. And I'm going to pop them all in a guide on VSGD Career so you can access them easily. But just a huge thank you, Ruth. That has been insightful. I've definitely learned a lot on that one, because I realized as I was thinking about what questions to ask you that I actually did not know very much about this topic. So thank you.
Hopefully you do now.
I do, yes.
And it's okay not to know, because that's why we're here, is to help.
100%. Like, nobody teaches us this stuff, do they, at the end of the day? And I imagine actually as people know that maybe they do want to have kids, maybe this has just never been on your periphery. So certainly until I started thinking about the different people in the profession that we can serve, whether that's at job changes, whether that's parents, that was the only reason this question came up. So yeah, it's okay not to know. We're not financial advisors, we're vets, vet nurses, practice managers, ACCAs, ANAs, right? So that's why we come to someone like Ruth. So thank you again, Ruth. We will be back next week. We'll come up with a topic and we'll look forward to seeing you all on Friday Finance. I just saw that Emily had said hello to us as well in the chat. So hi, Emily. Thank you for joining in with us. I hope it's been useful to you. Please do reach out if there's anything we can help you with. And thank you.
All right.
Take care, everyone.